In short-term trading, timing is pretty much everything. But what if you could cut through all the noise with just one simple indicator? Well, today we're going to break down the KDJ Indicator. It's a seriously powerful tool designed to help you do exactly that, even if you've always found charts a little, well, intimidating.
So, are you looking for a more direct way to time your entries and exits? A method that just cuts to the chase and gives you a clearer signal for those quick, 3 to 5 day market moves? Well, that is exactly what the KDJ Indicator was built for.
And this quote, it really gets to the heart of what we're doing today. We are skipping all the complex theory. We're going straight for the simple, practical stuff you can start using right away. No nonsense, just the good stuff.
Okay, so here's our game plan. First, we'll pull back the curtain on what the KDJ Indicator actually is. Then, we'll break down its 3 key lines. After that, we're diving into the most important signals, the golden and death crosses, and how to spot those critical overbought and oversold zones. We'll wrap things up by looking at its limitations and giving you the core takeaways. Let's do it.
All right, first up, what is this thing? The KDJ Indicator, which you might also hear called the stochastic indicator, is a super popular tool, especially in Asian markets. Its main job is to help us measure momentum and spot potential buy and sell signals specifically for short-term trends.
Now, if you go and look up how KDJ is calculated, you're going to find a bunch of really complicated formulas. We are going to completely ignore those. Seriously, the computer does all the math for us. Our job is to learn how to read the chart, those 3 little lines, and use them to make smarter decisions. It's all about practical application.
To really get the KJ, you just need to know about its 3 lines. And lucky for us, there's a wonderfully simple way to remember them, the big, medium, small analogy. Think of it like this. The K line, that's the yellow one, is the big line because its value is calculated first all on its own. Then you have the D line in blue, which is medium because its value actually depends on the K line. And finally, we have the J line, our purple line, which is small because its value is calculated using both K and D. See that hierarchy? It's key. So, here's the most crucial point. For our brutally simple method, we only need to focus on one line, the J line. That's right, the purple one. It's the most sensitive of the 3, and it gives us the clearest, fastest signals for those short-term moves. It's going to be our main focus for this entire strategy.
Okay, so how do we actually use this J line? Well, the most powerful signals come from how that purple line interacts with the other 2. This creates what we call golden crosses and death crosses. This is where the magic happens.
First up, the golden cross. This is your buy signal. It happens when our purple J line, coming up from a low position, usually way down below the 20 level, crosses up and over the yellow and blue lines. This is a huge hint that momentum is shifting to the upside and a new trend might be starting. And yeah, it's pretty much that simple. You see that purple line slice up through the others from down low? That's your cue to start thinking about buying. Now, on the flip side, we've got the death cross. And you guessed it, this is your sell signal. This happens when the J line, from a very high position on the chart, we're talking up above the 80 level, crosses downward through the K and D lines. This tells us that the buying party might be over, and a downward trend could be right around the corner. So this is the perfect counterpart to our buy signal. When you see that purple line take a nosedive through the other lines from way up high, that is a very strong signal that it might be time to sell or exit your position.
But it's not just about the crosses. The actual level of the J line itself is an incredibly powerful indicator of market sentiment. It basically tells us when the market is getting way too hot or way too cold. So check this out. When that purple J line travels all the way up above the 100 mark, it's screaming that the market is severely overbought. Enthusiasm is at an absolute peak. The price is often stretched way too far, and a pullback becomes much, much more likely.
And conversely, when the J line drops below 0, well, that indicates a severely oversold condition. This means the selling pressure has been just brutal, and the market could be seriously due for a rebound or at least a quick bounce. This table right here, this is your cheat sheet. Honestly, just think of these as zones of action. If you're above 80, you're in the overbought zone, and you should probably be thinking about selling. If you're below 20, you're in the oversold zone, and it's time to prepare to buy. And those extremes, above 100 and below 0, those are your strongest warnings to really pay attention. So KDJ sounds pretty amazing, right? And it is, but it's not a crystal ball. To use it really effectively, we have to understand its ideal conditions and, just as importantly, its limitations.
First thing to always remember is its specialty. KDJ is extremely sensitive, and it's designed for the super short term. We are talking about predicting moves that happen over just a few days. This is not the tool you use for predicting long-term trends.
And this brings us to a really crucial point. KDJ works best when you pair it with another, less sensitive indicator like the MACD. Think of it this way. KDJ is your timing tool. It's like the sprinter that helps you pinpoint the exact moment to get in or get out. The MACD is your trend tool. It's the marathon runner that confirms whether the overall, bigger picture trend even supports your trade in the first place.
And finally, you have got to be aware of two major limitations. The first is something called passivation. In a really strong one-way trending market, the J-line can just get stuck in the overbought or oversold zones for a long time, giving you a bunch of false signals. And second, in choppy, sideways markets, the signals become way less reliable because the J-line just kind of wobbles around the middle.
Okay, we have covered a ton of ground. Let's boil it all down into a simple, actionable checklist that you can use starting today.
So here it is, your final checklist. Number 1, focus on the purple J-line. That's it. Number 2, your buy signal is a golden cross down in the lower zone. 3, your sell signal is a death cross up in the upper zone. 4, be super cautious at the extremes, above 100 and below 0. And 5, probably the most important rule of all, always confirm the bigger trend with another indicator like MACD.
You know, at the end of the day, indicators like KDJ, they're just tools. They give us probabilities, not certainties. The real skill is in using these tools with discipline, managing our own emotions and biases. The real challenge isn't just reading the chart, it's mastering ourselves. So the real question is, are you ready to take that on?
This video is solely for sharing personal experiences and commentary. It is not investment advice. Any viewpoints represent personal opinions only.